Good afternoon. It's Rob Murphy here from Edison, and it's Wednesday, the 18th of November. And I'm very pleased to be joined by Neil Rogan, who's the chairman of Murray Income Trust. And for those who aren't aware, they announced back in the end of July that they would be merging with the Perpetual Income and Growth Trust. The Murray Income Trust is 5-star rated by Morningstar. It's managed by Charles Luke of Aberdeen Standard Investments. And it's also a dividend hero. So it's had more than 20 years of dividend growth, consecutive dividend growth, and it's actually 47 years. So an interesting merger, and very pleased to have Neil Rogan with us today. Welcome.
Thanks, Rob. Hello.
Great. So let's just start from the beginning. How did this transaction come about, and what made Murray Income Trust decide to get involved in this?
Well, it started with the announcement by the Perpetual Income and Growth, which I'll shorten to PLI. The PLI board on April the 6th that they were looking for a new manager. They put their previous manager, Invesco, on 6 months' notice. And we saw that announcement. I'd seen it on Bloomberg that morning. And I phoned up Aberdeen, my counterpart at Aberdeen, William Hemmings, and said we would like to look at this. And he'd already decided that they wanted to look at it from an Aberdeen point of view. So from that point onwards, we worked together on it, and it all flowed from there.
Right. So really, it came from your side, just getting in touch with the board of PLI and taking it from there. And I suppose in a way, I mean, the trusts are in the same sector, but they've been run quite differently. So what made you think that when you sort of decided to approach them, that would be a good thing to take a look at?
Well, it's one of the things we always think in terms of the benefits for our shareholders, and then if we can be of benefit to somebody else's shareholders, that's an extra win. From our shareholders' point of view, we knew that if we managed to pull this off, then we could bring the costs down substantially for the existing shareholders. So there were substantial benefits for our existing shareholders. From a PLI point of view, obviously they were looking for a new manager, and our manager has a fantastic track record at the moment. So in terms of the people, process, performance that they had and we could offer them, that was interesting to them. So to do, from their point of view, to do it and get a fee reduction, we thought would be interesting for them. So that was the basis of the proposal.
And so what was the beauty parade process? Because the board of PLI obviously had gone ahead with the search for a new manager. So maybe you could talk through how that worked in lockdown as well.
Yes. It was originally Winterflood and Mercer's were running it for the PLI point of view, and we were asked to, or everyone was asked to, invited to put in submissions, expressions of interest. We were then asked to submit RFPs. It was a very detailed document, which took quite a few weeks to work on. A little bit more difficult, as you say, being from home, everyone working on Zoom, not being in the office together. And it ended up with we were invited to pitch, but as normally happens in these cases, it's quite a few were just investment houses, investment management companies pitching for the management contract to leave the trust independent. So that was the bigger obstacle for us, because normally when an investment trust puts out a request for a new manager, the outcome is they just choose a new manager. They don't normally merge with another company. So we had an extra level to overcome, but we did.
Yeah, no, that's an interesting point, because I think we have seen a little bit more consolidation the last year or so. So, and as you say, those have generally been moving to new managers without an actual merger going ahead. But I guess what do you think swung it from the PLI board side rather than just going with an external manager?
There's probably a number of factors. The one I like to think made a difference was effectively the closing line in our pitch to the PLI board. which was we were saying that they would struggle to find a better manager than Charlie Luke for 38 basis points, which was the blended management fee that we would be able to offer them because of the nature of our tiered fee structure. And I think that probably was true. I think it was certainly our strongly held opinion, and it seemed to sway things in our favour.
Yeah, and I suppose the other interesting thing is, you're going to have total assets of more than $1 billion, and in a period when I guess liquidity is becoming more important, it's just a much more scalable trust now, and much more liquid, I guess, for investors to consider, especially the professional investors with larger portfolios.
Yes, that's right. Our blended management fees coming down from about 50 basis points to about 38 basis points. As you say, the liquidity of the shares should improve. We've already started to hear that back from the market makers now. The spreads reduce. We qualify for entry into the FTSE 250, so all of those things should benefit both sets of shareholders.
Yeah, absolutely. And so maybe we'll talk a bit about the board then. So you're keeping 3 PLI directors on the new board. What was the reason there?
Yes, we are. That's again unusual. It turns out, from our point of view, there were 6 directors on the Murray Income board. We had 2 due to retire next year anyway in the ordinary course of events. They would have completed their 9-year term. Non-executive directors complete 9-year terms and then retire. So we were going to be looking for 2 anyway. So it then became not too much of a stretch to go from 2 to 3. Because Richard Lang, who is the former chairman of Perpetual and Growth, he was due to retire next year as well. So we've gone from 6 to 9, but we will go straight back to 6 when 3 of them retire at our AGM next year. So it's a temporary increase. It's within the overall amount that we're permitted to pay directors. But I think it probably did help again with the outcome of choosing a merger rather than a new manager as well. And certainly as chairman, I was quite keen just to have some flexibility on that and to see where we got to. And I think we have come up with an outcome that's good for both sets of shareholders. So I'm happy with where we've got to.
Great. And in terms of timing then, so July seems a long time ago. What's been the sort of various hurdles that you've had to get through to actually completing everything?
Yeah, there's a lot of legal stuff that goes on in the background. As you probably know, drawing up a prospectus and a circular that we had to do, and then arranging the general meetings, the lawyers' meetings, all during a period of lockdown. But we've got there in the end. But there's been a lot of work going on behind the scenes.
Right. And so now the deal's gone through. What's actually sort of happened? Are the portfolios just merged? How have you treated the PLI holdings?
Yeah, that's a good question. That's one that a lot of the shareholders have been asking. Effectively, what's happened with the PLI portfolio? 20% was a cash exit, so 80% was left to roll over into Murray Income. Now there was a PLI appointed Aberdeen Standard to be the transition manager or advisor before the merger was actually put through. So what actually happened was the rollover portfolio, the 80% portfolio, was aligned with the Murray Income portfolio before the fair value transaction date, so before the merger actually took place. So that was done. So when the transaction was actually done, we just took on the stocks that were already in the rollover portfolio. We have to pay stamp duty on them, but then it's already in line. So to give you some numbers, there were 10 stocks that were in this rollover portfolio that came into Murray Income that were in the original PLI portfolio. So only 10 of the original holdings were retained. Those 10 were all stocks that Charlie held already in Murray Income, so there are no new stocks in there. All the illiquid investments, the ex-Barnett investments that people seem to be worried about, they were not retained. They didn't come over. So we only took 10 stocks over.
Yeah. Okay, that's interesting. And so now we're through the process. We've talked about the advantages in terms of the scale, the reduction in fees for the Murray Income shareholders, and we've talked about the advantages for the PLI shareholders. Again, the scale, the fees, plus also obviously the very strong track record of Charles Luke at Aberdeen. So what are the disadvantages? Because I think there are some technical issues around the revenue reserves as well.
Yes, yes, that's a good point. That's another question that came up quite a lot. The technical issue is that when you do an investment trust merger, you can't bring over the revenue reserves to the new trust. They have to be paid out as a special dividend to the existing shareholders. So that's what PLI did. They paid out their revenue reserves to their shareholders in a special dividend. It's about a month ago now, early October. So the effect for us is that our revenue reserves are diluted by the increase in size of the trust. So to give you some numbers, our revenue reserves before this happened were 22 pence, 22.0 pence. With the effect of the merger, they fall to about 12.5 pence because of the increased number of shares. The sterling value of those reserves is untouched, but because there are more shares, it's a lower number per share. To give that some context, our dividend is 34.25p. We earned 30.5p last year. So we used in our dividend payment, full year dividend payment for the year just ended to June 2020, we used 3.75 pence out of our revenue reserves. And with that having been used up already, with the increase in size of the trust, we've got 12.3p of dividend reserves, revenue reserves left. So we've kind of got enough. I've used the term 3.25 COVIDs. What we've just done, we can do 3.25 more years without using up the reserves. So we think we're not going to run out of revenue reserves, but we're certainly closer than we would otherwise have intended to be. So one of the things we've done about that is that in the general meeting last week, we asked shareholders, and it was approved, that we can pay dividends out of capital should we ever need to. We don't intend to. That's really an insurance policy, just in case there is another, the COVIDs go on more than 3.25 years, or there's something else bad happens. But it provides an insurance policy which gives us some confidence on future dividend growth. So that's the revenue reserves being diluted is one of the disadvantages. The only other one really is on costs. There are some costs in the transaction. For Murray Income shareholders, it is around about 35 basis points of one-off costs of the transaction. The biggest component of that is the stamp duty on the new shares being transferred in, which is about 22 basis points. The other 15 being the legal costs, etc., etc. So one-off cost of around about 35. The benefits in terms of lower fees, lower ongoing charges, run at about 23, 24 basis points in the first year, and then about 15 basis points for every year after that. So in the second year, it becomes accretive to our existing shareholders. It's already accretive to the PLI shareholders. So in the end, it is everybody's better off. It's a win-win situation, but there are one-off costs that go through at the beginning as well.
Yeah, understood. And so just coming back to the dividend then, so you are a dividend here with 47 years of dividend growth. Are you still intending to maintain that record going forward?
Yes, very much so. Yeah, that's a core part of the trust. So definitely, that is the intention.
Excellent. And what's been the feedback from both the Murray Income and the PLI shareholders?
It's been very positive, actually. In general, we've had a lot of very positive comments in saying, yes, well done, good for Murray Income, good for PLI, obviously, good for the industry. We had a few questions which sort of touched on what you asked earlier. We had a few shareholders worried that we were taking on the illiquids in the PLI portfolio. There were some people that were worried we were merging the two portfolios, didn't like the idea of that. There were a few questions about the PLI directors joining as well. The questions on the revenue reserves as well, that came up a few times. And the other one was that people wondering about the rating. We've got, we were trading at an average discount of around about 6% over the last 12 months. The PLI I think were around about 14 or so. So some people were worried that we'd end up at some sort of average of those two numbers as a rating. And of course, that's something that we can't control directly. We can't predict. It's subject to market forces. But the early indications are very positive because the discounts actually come in quite sharply. So it's now, at the time, it looks like we're getting very close to trading at asset value. The discount last I saw was 1.5%.
That's right. So, I mean, that sort of tells us, at least so far, it's pretty well received. I guess another technical issue was the 60 million loan that PLI had, which matures in 2029, and you've decided to keep that. I mean, it's yielding 4.37%. What were the reasons there?
Yeah, that's a loan that they took out quite a while back, hence the high coupon. But the transfer was at fair asset value, so it transfers to us at market value. So effectively, the rate we pay is lower than that. We wanted to have the director's view is that the neutral level of gearing for Murray Income should be 10%, and we needed this amount of loan to get us, in fact, just slightly over that. So so we were keen to keep it on.
Great. And then maybe finally, Charlie has had a great record. What do you think is behind that? Because there's lots of trusts in this sector. What's been different about his approach?
In a word, it's quality. I would say if you ask him how he does it, what's his investment approach, the word quality comes up more than any other word. We want a high and growing income, but the Aberdeen Standard approach is to get that from quality companies that are reliable in terms of what they're doing. Quality, it's not just in terms of the of what they produce, or the ESG credentials. It's particularly about the quality of the management and the quality of the balance sheet. And it's an investment style. It doesn't always work, but it's been working for the last 3-4 years or so very well. It has had a very good crisis because clearly, if you had strong balance sheets, you were much better able to withstand the sudden economic shock that we've gone through in the last 8 months or so. And it seems to continue to do well. The other thing, people's again question has come up over the years is they recognize the quality style, they allow for that, and they still say, well, yeah, but Charlie's done much better, even notwithstanding that in the last couple of years. What else have you changed? What else has changed? And there is one other thing that I will point out is that he has become much stronger on his sell disciplines. So in other words, when a holding starts to go wrong, he is now much quicker to react and to deal with it, and in many cases sell the stock before it gets into a lot of difficulty. So whereas maybe 5-10 years ago he'd have held on to a stock for quite a long time as it was trying to help itself recover, this time to quote an old film I can't remember the name of now, it's sort of shoot first, ask questions later when it comes to these things.
Yeah, and I think these days things seem to move very rapidly, don't they? In terms of a company can get disrupted very quickly, and you know, you need to be on your toes. I mean, in terms of the outlook for the shares, I mean, you know, his qualities worked out well. I mean, I do note, you know, he's been generally very overweight in tech, healthcare, which, as we know, have done, you know, in some way, many of these stocks have actually gone to new highs, you know, through the crisis, and he's been very underweight the financials and oil and gas. I suppose we're seeing a bit of a bounce back in some of those sort of more damaged sectors with the news we're getting on vaccines. I mean, is that going to affect the way Charles is going to look at things from here?
I don't think it's going to affect the way he does things. No, you know, what he would define as a quality company is not going to change, particularly just because some macro event has changed and there's a bounce back in other companies. It is true that you know, if the vaccine causes an economic recovery, then the poorer companies that have had a really tough time over the last 12 months or so may well bounce back quite strongly. But I mean, to be honest, it's too early to tell them. You know, when I was writing my chairman's statement a couple of months ago, I was writing that there are at the moment there are just too many large variables that are almost impossible to predict which way they're going to go. So if you're going to make an investment forecast on the back of all those variables, you're necessarily going to have a very low level of confidence in whatever prediction it is. It's just not a time to take big risks or have big bets at the moment. And it just strikes me that if you stick to companies that you know well and you still like and still think will do well, which is what Charlie's doing, then that's a pretty sensible way of navigating through all this.
Yeah, great. That's a good point. Yeah, he's sticking to his knitting, and which has worked consistently well. Excellent. Thank you very much, Neil, for sharing those insights. It's a very interesting transaction, and good to see that the investment trust sector continually manages to reinvent itself to stay up with the times. Thank you very much.
Okay, thanks so much, Rob.